chair of the finance department since 2008. He is a graduate of the United States Naval Academy, and following his naval service, he went to Indiana University where he received his master's and PhD degrees, and has primarily been here since then. I don't want to take any more of his time. Let's welcome Dr. Mendenhall.
Thank you. Can you hear me? Sounds like it's booming, so. Thank you very much. Thanks for having me. I know you didn't have any choice, right? But anyway, thanks for participating today. And let me see, I don't know if I have this worked out. I'm getting okay, got it. The topic is, what is finance? And I want to start by saying that finance is huge, right? Almost any time money changes hands or somebody makes a decision about money changing hands, finance is involved. And so I don't think anyone, I will try to keep it to about 15 minutes, give or take. And I don't think anybody can tell you what finance is in 15 minutes. But I hope to just give you a feel for what finance is in that time. So let's get started. I view finance this way, and I know several other finance professors do as well. You can break finance in different ways, break it down in different ways. But one way is you can break it into corporate finance, investments, and financial institutions such as banks. And I borrowed this graphic from Catherine Spies, who's the assistant department chair in the finance department chair. And I don't think she's trying to say they're of equal size or how big the overlap is, just three different general areas of finance, and they do overlap. You know, you can ask yourself, well, is this more corporate finance or investments? And it might be on the intersection. Now, my understanding is that you haven't had any accounting courses or anything like that. Is that most of you, right? So I think Fred Middlestat, the chair of the accountancy department, talked to you about a month ago. And so you may not remember what he had to say or everything he had to say, but one of the things that accountants do is they produce financial statements. They produce quite a few financial statements. One of them that they produce is called a balance sheet. And I find the balance sheet useful for talking about finance. Finance people and accountants work together. The balance sheet has assets on the left-hand side and liabilities and equity on the right-hand side. So what's on the left-hand side? It's the things, the stuff that the firm uses to produce goods and services. So we're talking about land. Land is a thing. Plants, other types of buildings, equipment, machinery, whatever it takes to produce goods and or services that the firm will sell. The firm will sell them to make revenue, earn money, but also to make people better off, so they can employ people, and also so that you can have your iPhones and your iPads and your automobiles and whatever else you consume, whatever else you use. Now, we're going to talk about this side to start with. We're in corporate finance. Corporations like Eli Lilly, which is headquartered in Indianapolis, or Johnson & Johnson, that has, I never know how to say this, Dupuy, whatever, it owns a company just down here in Warsaw, Indiana, or we're talking about Ford Motor Company or Whirlpool, et cetera. So we're talking about corporate finance, we're talking about the investment decisions, sometimes called capital budgeting, and I just want to give you a feel for what we're talking about. Should FedEx or Delta or whoever buy one type of plane from Boeing or another type from Airbus? This is an operational decision, but it's also a financial decision. For example, just keeping it simple, you might be looking at two different types of planes. We have to trade off the cost of purchasing the plane with the cost of maintaining the plane, the fuel cost, maybe one's more efficient than the other, and maybe they have different lengths of lives. Maybe we think that one plane will last for 20 years and the other one will only last for 15. Finance people have to be involved in making all of those trade-offs. Should we introduce this new product? Whatever we're talking about, whether it's Eli Lilly making a drug or Ford Motor Company making an automobile, or it's Coca-Cola with a new soft drink, finance people have to be involved in determining, does this make economic sense for our company? If we make this new automobile, is there a big enough market? Are there enough people who would be willing to buy it so that it makes economic sense? And finance people are involved in that decision. They're looking at the market with probably marketing people. They're looking at the size of the market. They're saying, this is how much we think we could sell it for. What are the positive cash flows? How much will we have to invest in plant and equipment, et cetera? What will the variable costs over time be to build this car? Does it make economic sense? These are investment decisions. A simple one would be, should we build this component or should we buy it? There's a man named Lee, no longer living, a deceased man named Lee Iacocca, who was an executive with Ford Motor Company and then later with Chrysler. And he had an opportunity one time to buy engines that were completely developed. They were very functional. They'd been tested. He could buy them from a Japanese automobile company, and he could just plop them into his vehicle. And he said this was wonderful because we could just buy these engines and put them into the vehicles of our choice. Well, people in his company overruled him and said, no, we're not going to do that. They didn't want to have Japanese motors in their cars. They wanted the pride of developing their own motor. Bad financial decision. Cost his company a lot of money. So finance people could tell him exactly how much that cost him, right? Actually, they would probably advising him, don't do that. Let's buy these engines, drop them in the cars, much more economically valuable to our company. Almost every business decision has financial consequences and requires finance people to assess those consequences. I'm going to give you a quick example that's kind of outside of thinking about making cars or soft drinks, et cetera, and that is many years ago, there was a radio station in Chicago, and I don't remember the call letters, but I'm guessing this was 25 years ago, maybe 30, when there was a radio station that advertised over and over that we're going to go for 6 weeks without commercial interruption. We're going to go for 6 weeks. And why they advertised this so that people would start listening to their radio station. And what were they doing? They were making an investment. They're saying, we're going to give up a set of cash flows today in exchange for what we hope will be big cash inflows in the future. So they were saying, we're going to give up all the revenue we could get from advertising over the next 6 weeks in the hopes that as people listen to our radio station, as they get to know us, especially without commercials, they're going to say, wow, that's a really good radio station. They'll get used to listening to it. Our listenership will increase dramatically. And then when we do start introducing advertisements, we can charge more for them. That was an investment decision. I certainly hope there were finance people in the back rooms working together and saying, hey, this makes sense because this is how much we think we're giving up. This is how much we think we'll get in additional revenue over time. After costs, it'll be this much. Hey, all the cash flows make sense. I don't know if they did have somebody in the back room doing that work because the station went out of business. So still, I think it's a good example of something other than a physical investment, like we build a plant and that plant builds automobiles, et cetera. Okay, let's keep going. On the other side of the balance sheet, we're still in corporate finance, we have liabilities and equity. This is the way the firm obtains money, the way it obtains money to use to invest in the land, plant, equipment, and people's salaries, et cetera, all the expenses used to generate the goods and or services that they produce for society, that they produce for their customers. These are called financing decisions or capital structure. Now, here are just some examples. Here are just some examples of capital structure decisions. Okay, firms raise money to obtain assets by issuing stock and bonds. Finance people decide how much should we raise through equity, stocks, and how much should we raise through debt. Now, there are trade-offs involved because debt, it turns out, is cheaper than equity. You pay a lower rate on debt than you do on equity. So you think, let's use more debt. But the problem is debt makes your company riskier. And so you have to trade off these costs and benefits. And there's a lot more to it, obviously. There's a lot more to each of these problems. I'm just giving you a feel for them. How much of our debt should be short-term versus long-term? We have to think about, we can borrow money for a year, we can borrow money overnight, or we can borrow money for 30 years or 20 years. Finance people are involved in that decision. How much does it cost us? This is a big thing that finance people address, and it's called the weighted average cost of capital for a company. You can buy books from Ibbotson or other consulting firms that will give you estimates of the cost of capital of companies. And so the next question is, how much does it cost us in annual percentage terms to raise money to use for assets? So how much does it cost me 8% a year to raise $1, or does it cost me 14% per year to raise $1? And on average, my investments, my projects, the products I invest in should earn me more than my weighted average cost of capital. If I can do that, then I'm creating value. I'm creating value for my shareholders because I make the company more valuable, but I'm also creating value for society. Let's not put it in percentage terms, but let's put it in dollar terms. If I can take $5 of the world's resources and I can make a product worth $7, I've created $2 of value. I've made the world wealthier. Okay, finally, how much should we pay out to our shareholders in dividends? Dividends are cash disbursements to our owners, the owners in our firm. That's the dividend policy decision. And this is something that finance people would be involved with. Okay, let's continue. Shifting from corporate finance to investments. Remember, these do overlap, but we've got one area called corporate finance, another area called investments. In finance, we look at how people make investment decisions. We've been talking about corporate investments, but now we're talking about buying stocks and buying bonds, taking positions. This is called, if we try to beat the market, if we try to pick good ones and bad ones, then we're talking about what's called active management, trying to determine good investments and bad investments. We also, in finance, we talk about how difficult or easy it is to beat the market. We talk about the factors that make it difficult to beat a market or easier to beat a market. We call this market efficiency. Another way to think about market efficiency is how smart are market prices? Do market prices impound a lot of information, or are they not so informed? If prices impound a lot of information, then it's going to be difficult for investment managers to pick the good ones and the bad ones. If prices don't impound a lot of information, it won't be so difficult. How should investors optimally split their money across investments and asset classes? This is called portfolio theory, sometimes called modern portfolio theory. How should investors invest optimally? And that sounds like the whole thing, right? Well, this section is sort of like physics saying how things will work in a vacuum. We make some assumptions and we derive some principles, and we can give these directions. Those principles allow us to give directions to investors in the real world, to say, under a certain set of conditions, this is how you should invest optimally. So that's called portfolio theory. Okay, finally, how can derivatives, when I talk about derivatives, I'm talking about something that derives its value from another security. For example, an option on a stock or a futures contract on a different type of security, a futures contract on gold or on corn. How can they be used effectively? And certainly, they can be abused. A guy named Warren Buffett, who you may have heard of, good chance you've heard of him, says that derivatives are financial weapons of mass destruction. Well, they certainly can be, and they have been. And I'll talk about one case in which I would say they were used as financial weapons of mass destruction. But they can also be used, so they can be used in very risky positions, but they can be used to reduce risk. And that's one of the things we study in finance. How can I use options to make my position actually less risky? Okay, let's continue. Okay, so we've talked about corporate finance. We've talked a little bit about investments, a whole lot on that one slide, actually, if you think about those topics. Are we doing okay today? Are you? Oh, I bet you're getting ready for spring break, aren't you? Is that what you're thinking about? Well, I can tell some of you are thinking about finance. You're riveted. Okay, let's continue. Let's talk about financial institutions, and I won't have as much. I think I've used up all my time already, so I'm not going to belabor these. But when we talk about institutions, it's just like it sounds. We're talking about banks. We're talking about commercial banks. We're talking about investment banks. A lot of people want to be investment bankers. Why would somebody want to be an investment banker? What's so appealing about that lifestyle? Anybody know? Anybody want to be an investment banker? Yeah. They make a lot of money. They make incredible amounts of money if they're successful. Yeah, so a lot of people want to be investment bankers, and I'm going to talk about where we place people as we go through the rest of the slides. I apologize for taking, okay. I'll just keep going then. By the way, we're on slide 8. I have 15, but they'll go pretty quickly. 15 total, okay. There are lots of financial institutions. Insurance companies are financial institutions, pension funds, et cetera. Let's continue. Okay, I want to talk about, I've got some nice pictures, so I just want to talk about some things that I find interesting in finance. By the way, if I sound excited about finance, I'm a finance person. And I want to make it clear that I'm not trying to recruit finance majors. I think you should all think about what you find interesting, what you want to be. Hey, I was your age once, believe it or not, and I know that's tough. For most of you, it's going to be difficult. I had 2 boyhood friends. One always wanted to be a veterinarian, and one always wanted to be a lawyer. And today, one of them's a veterinarian, and one of them's a lawyer. And they didn't switch. I mean, but I always envied them because from the time they were 10 years old, they knew what they wanted to be. That's not the way I was, and I'm guessing that's not the way most of you are. But my point is, you have to try to figure out what you want to be, and you have to go in that direction. I'm not trying to recruit you. I noticed we had 275 sophomores who have declared finance as their major. So we're a popular major. I understand that because I'm a finance person and I find finance fascinating. Okay, I could talk all day and you don't want that, so let me keep going. Finance people find pictures like this interesting. This is a company called Long-Term Capital Management, which you may have heard of. And Long-Term Capital Management, in a space of about 4 years, was able to take $1 and turn it into $4. So that's like investing $10,000 today, and the next time we start talking about a presidential election, you've got $40,000. That's an awfully good return. So we find that interesting, but we find the next little part of this picture even more interesting, and that is, so how did Long-Term Capital Management, how were they able to turn $1 into $4 over 4 years, and then over the summer, they lost everything they had made and more. And they would have gone, this would have just kept going other than the United States government stepped in and said to a bunch of banks, you got to bail this guy out, or else we don't know what's going to happen to the economy. Long before the current financial crisis, we had things like this happening. Okay, some other things that finance people find interesting. AIG, this is my example of financial weapons of mass destruction. AIG was America's largest insurance company. They were one of the 30 Dow Jones Industrials. How many companies are publicly traded in the United States? Thousands. And those 30 Dow Jones Industrials are huge, important companies. AIG was one of those companies, and they should have lost all of their value. They were the largest insurance company. So we asked questions like, what was a small AIG office in London doing that destroyed all of its value? 100% of its value. In fact, it still owes the US taxpayer $50 billion. By the way, when I was your age, if somebody said, what comes after $1 million? I'd have to think, $1 billion, I guess. Today we throw around words like million, billion, and even trillion. So $50 billion to some of us is still quite a bit of money. What is the reason? We talk about things like the financial crisis, its causes. You know, could we have prevented this? Could we have foreseen it? Can we prevent the next one? And we actually have a class now in finance that is taught by a guy who was a local bank president, John Rosenthal. He teaches a class specifically on the financial crisis. And we talk, of course, there are many lessons from the financial crisis that appear across our curriculum, in our existing courses. Okay. There are 2 people in this picture. I asked about the guy in the blue tie. Do you recognize either one of these people? Go ahead. Warren Buffett is on the right. Yes, that's Warren Buffett. And something important about him? I quoted him a little earlier, but he does very well for himself, yes. Here's my hint, you didn't need it. Last year, and for several years, I think, Forbes magazine listed him as the world's third wealthiest person. And how did he get there? Well, that's an interesting question. He's an investor, and I would say he's the best investor starting with the second half of the 20th century to the present. He's been the most consistently superior investor over about 50-year period. Does anybody recognize this guy? Anybody recognize him? That's Shane Corwin. He's one of our professors. And notice he's taking some money from, somehow he's talked Warren Buffett out of a little bit of his money here. No, we send people to Omaha, Nebraska to meet Warren Buffett every year. A group of MBAs go, and every year we send a faculty representative, and Professor Corwin was our representative, and Warren Buffett always invites funny pictures. Yeah, go ahead. Where is it? What is it?
I live in Omaha, so I think that's.
What'd you call it?
Grot Steakhouse.
It could be. It could be. Is that his favorite or just a favorite?
Yeah, for the big Berkshire, he rents out the whole restaurant.
I suspect it is. I'll ask Professor Corwin, and if you send me an email, and if you Google Mendenhall, Notre Dame, I'll pop up. Send me an email, and I will let you know. Okay. Anyway, where does that take us? Last year we had 220 finance graduates. They took jobs with almost exactly 80 different companies. It's not like accounting, where a lot of the accounting majors go to the big four firms. Their market is dominated by 4 large accounting firms. We're not like that. We sent 9 to Credit Suisse. Well, you can see the numbers. You can read them as well as I can. The thing I will point out is our market, where we send people, has changed dramatically over time. At least that's my assessment. Take a look. Credit Suisse, JP Morgan, Morgan Stanley, Citigroup, what do they have in common? They're investment banks or have investment banking sides to them. We send a lot of people to investment banking. If you'd asked me just a few years ago, if you'd said, I really want to be an investment banker, I'd say, that's great, but you're going to have to work at it. You're going to have to go to New York. You're going to have to knock on doors. You're going to have to use every contact you can, and good luck. I mean, it's very competitive. Well, we have people working in this area. We have a group called the Wall Street Leadership Committee, which is made up of a bunch of alums, and they work to get people internships on Wall Street, internships with investment banks and investment managers, and they have been succeeding. A guy named Carl Ackerman, one of our professors, works with people to get them internships, and he told me he thinks part of this success is that we had a couple of young women who went to, I believe it was JP Morgan a few years ago, and as interns, and after the summer, they were ranked as the number 1 and number 2, both 1 and 2 interns for JP Morgan that summer. Well, JP Morgan said, hey, we like these Notre Dame people and we want more of them. So this is, I know you can't fully appreciate this, but this is huge for us. Now, at the same time, I want to make it clear that you don't have to be an investment banker to be in finance. I think, traditionally, our bread and butter has been corporate finance. And these old stalwarts. Maybe these are companies that you'd rather probably see Google and Yahoo up here, but somebody my age says, wow, these are great companies. Ford Motor Company, IBM, Johnson & Johnson, Target, Whirlpool, John Deere. We placed people at all those places last year. And I think being in corporate finance is much more of a regular life. Yeah, you probably won't make the huge amounts of money, at least not as soon, in corporate finance, but you'll have a more normal life. You'll have more regular hours, more reasonable working hours. Okay, this is slide 13. I know some of you are holding your breath. Would he please finish? Okay, bottom line, finance is a good major for some. Do you enjoy solving problems by thinking analytically? I think that's a big part of finance. A big part of finance is thinking analytically to answer questions, to solve problems. Do you enjoy working in a team environment? In finance, you're usually working with a team. You're usually working with other finance people. You can be working with marketing people who may be helping to assess the market for a particular product or a particular service, particular good or a particular service. Certainly working with accountants, the people who generate financial information. Do you have strong communication skills and self-confidence? I think that's probably necessary for everybody today, right? No matter what you do. Do you have a genuine interest in either corporate decision-making and or financial markets? Do you find them interesting? And again, it's I think one of your jobs right now is to figure out what you do find interesting. Find out what you want to do. Find out how you want to spend a good chunk of your life. Okay. And I'll finish up with some websites, and I can make sure that these get to you. And actually, I do want to do one. Oh, okay. Oh, good. Okay, so you have access to these. There's something I forgot to do, and I want to pop up. We talked about investments as being one of our three areas of finance. And I want to show you a website. We have a course called Applied Investment Management. And Applied Investment Management is a highly selective course. You have to apply to get into it, and they manage endowment money. Now, the MBAs take the course in one semester, and they take it in the spring, I believe, and the undergraduates take it in the fall. And it would usually be seniors, but I think they do have some juniors. This is their website for AIM, is Applied Investment Management. These are the stocks they're currently holding, and this is how much. Oh, they've lost some money today. Ooh, must be a bad day for the market, huh? But they're still managing about $6.4 million of endowment money. So Scott Malpass, who is the chief investment officer at Notre Dame, is involved in this course. He's not somebody who teaches it day to day, but he is involved. They take a couple of trips every year. They go to Chicago, and they go somewhere else. Sometimes they go to New York, sometimes they go to Boston. But the students run the course. It's a great opportunity. Okay, I can't believe how long I've spoken. You're saying I can. So let's go ahead and open it up for questions, if you still have any time for questions. Okay, and I'll do my best. I'll do my best to answer them if you have any. Yeah. I don't know which restaurant that was. I'm sorry.
Any idea what the average starting salary is at a Notre Dame graduate?
I think it's 60,000. 60,000. I think that's median, right? Because we've got a few, we'll have a football player or a basketball player who will skew the mean, but the median, so 50% higher, 50% lower than 60,000. Yeah, which I think is the highest in the business college, and one of the highest on campus, certainly. But I wouldn't let that drive my decision, because if you go into an area that you find interesting, that you find exciting, you will work harder naturally, you'll be more successful, and you'll do just fine. Yeah.
Is this AIM course only open to finance majors?
Ooh. I don't know that that's a requirement. But you have to apply to get in the course. And if you haven't had the other courses that are relevant to it, then you're not going to get accepted. And whether you can get into those courses as a non-finance major is problematic, because we just don't have enough seats in them. I mean, we're a big major. So I don't know that it's a requirement, but it may be a de facto requirement. Go ahead. I think most of the people who take this course are seniors, but it's possible, depending on if you came in with a lot of extra credits or something, you took the courses early, that possibly you could get in as a junior. I don't know if you guys know. Go ahead, Sam. Okay, that's what I thought. So almost all seniors, one or two juniors, usually. Other questions? Yeah. Ooh, I'd have to think about that. Well, you take intro normally in the spring of your sophomore year, and then in the junior year you have 3 required courses. You have corporate financial reporting, which is actually an accounting course taught by accountants, but specifically for finance majors. You have ACF, or Advanced Corporate Finance, which, I don't know why we call it Advanced Corporate Finance, because it's a follow-on to Intro. And so that's really, that addresses the corporate finance issues, capital budgeting, the things that I talked about. And then you have investment theory, which addresses investments. So those are the 3 required, and then you have a bunch of electives to choose from. We do have a book available that talks about the sequencing, talks about the courses. We're running low on these because we've had it for a long time. We are in the process of updating this and putting it online. So it will be online soon, and it will be updated. But if you certainly, if you want to look at this, it's going to give you a very good idea of the electives available, et cetera. But it all starts, now we do offer Intro both semesters. So you can possibly take it in the fall of your sophomore year as well, or fall of junior year. I think that's true. Stop me if I say something wrong. Okay. But most people take it in the spring of the sophomore year. So that's when it would all start. Other questions? Yeah.
So how big is the gap between what investment bankers make in corporate finance? Is it significant, or like you're not really going to notice the difference?
That's a tough question to answer. And the last thing I would look at, maybe not the last thing, but something way down the line is, what's my starting salary? Because again, if you choose to go into something because of the start, my niece went to Purdue, and she majored in chemical engineering because it had the highest starting salary of a bunch of majors. And she went there, in her first year, she said, this is the most boring topic I can imagine, and she left it. And I think that if you go into something that because you think, hey, I'm going to make a little bit more money, or even a lot more money, but if you're not happy, if you're not driven to do it, you'll be unsuccessful. I think the starting salaries are probably not that much different, but if you are successful in investment banking, not very many years down the line, you can be making 7 figures. If you're a successful investment banker, the sky's the limit. Which if you work for Johnson & Johnson, you're thinking about a more normal progression of salary, but also a much more, most people say, a saner lifestyle. Okay. If you're an investment banker, don't complain about working 80, 90, 100 hours a week at times. Yeah.
Do you have any advice for places to go to educate ourselves about finance?
Well, I think those websites, or do you mean?
Just like over the summer, just like that.
Oh.
Beyond, let's say, reading the Wall Street Journal.
Yeah. I think the Wall Street Journal is wonderful, and I think if you couple that with going to places like Investopedia or even Wikipedia, some of the stuff in Wikipedia is very sophisticated. So you can read something. I think the Wall Street Journal is wonderful, and you can read something in the Wall Street Journal and you say, I don't understand this. Start looking stuff up in Investopedia, Wikipedia. I think that's a great way to learn some finance and to figure out if you really find it interesting. Yeah.
If students are looking to go get an MBA after college,
Yeah.
Would it be worth it to get the finance undergrad degree? Like, especially if, you said that there's a layover between accounting and finance.
Yeah.
So is it worth it to go to finance and then go to MBA school, or would it be better to get a foundation in accounting first?
No, I don't think. Let me be completely honest and say people will take both sides of that argument. People who are knowledgeable and well-meaning will take both sides of that argument. I think if you want to be a finance person, go into finance. If you want to be a physicist, major in physics. If you want to be a chemist, major in chemistry. Engineer, engineering. Finance, finance. Because why would you if you major in accounting, then what's going to be expected of you? You're going to be expected to go into public accounting. Maybe you can go to work for a corporation, but you're not really doing finance. Accountants and finance people work together, but they don't do the same thing. And the last thing I want to imply is that finance is superior to accounting or anything like that. That's not my thing, but they are very different. Accounting is more past-oriented. It's like, what were the revenues? How do we account for the revenues? What were the expenses? How do we account? How much is this asset worth? And that's based on what we paid for it and how much we've depreciated. Accounting is backward looking. And that's not a negative thing. But finance, you have to deal with more uncertainty because finance is more forward looking. You know, how will this project do? You know, will this project succeed or will it fail? How will the market view this project? Will they view it positively or will they view it negatively? So I think, and especially if you think you want to be in investment banking or something, people will say, well, why did you major in accounting? You know, you must not be serious about finance because your classmates are going to major in finance. They're going to get internships with investment banks. They're going to maybe be hired as analysts in the analyst program for an investment bank, be there 3 years, and then be expected to go off, get a high-powered MBA, and come back. So let me again say, if Fred Middlestat's up here, he probably says, oh, get the accounting degree. It's a much better background for business. I don't agree. Yeah.
I've heard that you're expecting a lot of people to choose finance as a major, and they're going to limit the number of seats. Is that true?
We do limit the number of seats, but we don't if we don't have to. And I know this year we were concerned. I mean, we can't handle an unlimited number, right? We can't handle 325, but we got 275 this year, and we'll admit them all. I think it's that's some uncertainty about the future that none of us can see, right? I hope, as department chair, I would just as soon allow everyone who wants to major in finance, and we will do what we can to accommodate those people who want to be finance majors. At one time, we set the limit for 250, but we have blown through that, and because we, the finance department, have said we can accommodate more. So that's about the best answer I can give you.
How many students are in the business or are attending the business school?
Well, in the sophomore class is 660. Is that right? 600. So there's 660 sophomores who have declared one of the 5 business majors. One of the 6 business majors. Yeah. All I know is finance, right? So finance has 1 major. Management has 3. Okay. So there are 3 management majors. There's marketing. There's accounting and finance. So out of 660, we have 275. Yeah. So I'm hoping that we don't see people kept out of finance going forward. Other questions? I can't believe I've taken up so much of your time today. I hope you feel like you learned something. Oh, I'll take up a little more.
What did they start with for the portfolio?
Well, has any more been added?
It has been added. That was when the program started. The initial seed money was 500, but they did add more seed money.
Okay, yeah. So we can't. Please don't infer their return. But yeah, they started with $500,000. But this is a pretty impressive that we would allow a student class to manage close to $6.5 million. Okay. Well, thank you very much for your time and for having me in your class today, for paying attention. Thank you. You're too kind.